Nvidia shares giving up earlier gains in today's trading after its market cap surpassed $3 trillion for the first time ever this week. You're now looking at a pullback of just around 2%. But amid all the hype about AI in the market, our next guest still sees investment opportunity within this space, but it's not necessarily those larger cap tech names. He's here with some of those under the radar plays. For more on this, we want to bring in Hugh Gimber. He is JPMorgan Asset Management Global Market Strategist. Hugh, there certainly is no shortage of topics to talk to you about here, but let's start with some of the excitement surrounding AI, what we've seen play out for Nvidia and a handful of those larger cap tech names. You're actually seeing some investment opportunity outside of that. Where and what's the play?
I think that's absolutely right. The AI story is clearly a very powerful one, but there is no AI revolution to be had without the infrastructures to support it. So I think where we're finding now some of the more interesting opportunities in the market is some of the AI enablers, but really the left behind. So I'm thinking here about data centers. I'm thinking about clean power generation, even some of the raw materials that are required to build some of these chips. And that takes you into other sectors than just technology, because clearly there's a lot of earnings excitement around the tech stocks in the US at the moment, but they also come at a pretty hefty price. So for me now, the next wave of this story is to really think about some of the more reasonably priced opportunities in areas such as industrials or utilities, or even looking elsewhere in the world outside of the US, particularly towards Asia, where you have some of the really kind of key components of the AI story.
Talk to me about sussing out the trade in Asia, given some of the volatility there, and frankly, at some points, kind of the lack of transparency in what investors are getting into. What is the kind of framework that you would advise utilizing for just sussing out the opportunities in Asia?
It's a really good point. And I think this is where doing your homework on the individual names that you're buying is absolutely essential. But you take some of the examples that we find in markets such as Korea or Taiwan, and I'm not just thinking about the largest index players. Further down the supply chain, this is where we're really trying to pick through to hunt out the providers to the big players. Because let's be clear, all of the excitement around Nvidia and other names, but that today, to me, looks to be pretty fairly reflected in prices. You go back to the start of 2023, US markets have delivered very strong returns, but 40% of those returns have come from just two stocks. So this is now where we're reliant on our boots on the ground, the underlying company fundamental research, to try and hunt out some of the companies that can feed in to the AI story where it looks to be more fully reflected.
Hugh, we're seeing some early reaction here in the market here in the U.S. and then initially what we saw overseas following the ECB rate cut here. In terms of what ultimately that means, how much of that has already been priced in the market? What do you think?
So this is categorically good news for the European economy. Yes, it was well telegraphed by the ECB, and yes, they still have more to understand about how much further they're going to be able to go on rate cuts from here. But the key difference between the European and US economies is their sensitivity to interest rates. In Europe, we are much more interest rate sensitive for a couple of reasons. One, generally companies are more reliant on bank financing, and therefore cuts to interest rates will have a faster feed through to companies here. And then two, for the consumer perspective, the mortgage rate situation is quite different as well. We look very enviously at 30-year fixed rate mortgages in the US and that ability to lock in rates at low levels and then sit and hold those for a long time. When you have mortgages that are turning over more quickly, consumers are more sensitive on the way up when interest rates are rising, but then also will feel the benefit more quickly as interest rates come down. So when I look at European stocks trading on a 30% discount to the US market today, that's pretty much an all-time record wide in terms of that discount. This is where we're starting to question whether really that discount is fair. And I would argue it's not. I think there are more opportunities to be found in Europe today to take advantage of some of these underappreciated companies.
Well, let's dive into that because that's super interesting, Hugh. And I know in your note, you had a great point that really made me sit up. You talked about how because of the rate sensitivity in the US, a lot of companies are staying private for longer. And I wondered if that makes you think that for investors looking stateside, is the private credit market a little bit more attractive given some of that rate sensitivity?
Yeah, I think that's a fair point. And when we've looked at this, the trend is very clear. So let me take you back 20 years. You find the average company, when it decides to go public, it was roughly 4 years old. Today, when the average company decides to go public via IPO, it's 12 years old. And so there's additional 8 years that used to be found by small cap investors, which is now only accessible via the private markets, whether that's private equity or private credit. And it takes us back to that AI theme. You find some of the most exciting new companies that are yet to be discovered by the full public markets, which are going to sit and wait for longer and longer in private markets. And therefore, it's the private investors that are going to get access to a much longer set of returns. So this is where changing the structures really of capital markets are starting to impact asset allocation decisions, because there are simply opportunities that used to be available to public investors alone, which are now far harder to access.